Adrian, thanks so much for taking the time and speaking to us this morning on NDTV Profit. Are you watching the Fed policy and, of course, the inflation print? Is that the key determining factor for markets in the short term?
I think it's very important. We've had big swings in US bond yields. So 10-year bond yields briefly touched 5%, then came down to 4.15, and now moving a little bit higher. I think the story of the US economy is one of great resilience. You've got an economy that's generating a large number of jobs every month. Inflation is moderating, but it's still high. So if you look at the consensus for CPI-X, so ex food and energy, it's 4% year over year or 0.3% month over month for the print that's expected to come out on Tuesday. I think there's nothing there that will make the Fed come out with a more dovish statement. And my call for next year is that the Fed doesn't cut rates at all. The consensus is about 2 cuts. And I also think that the US bond yield is incorrectly priced. If this US economy continues to show this resilience, it is very illogical to have an inverted yield curve. So I could see some headwinds for risk assets if we see another sharp move up in US bond yields, which to me would be the biggest risk to markets.
Okay, that's a very interesting perspective, because everybody that we're listening to is talking about the potential for rate cuts as early as possibly even March. So when you say that you anticipate that bond yields could head higher, have you thought about how far they can go, and what does that mean for flows? Because we've seen bond yields come off very substantially. We've seen that the US dollar has given up some bit of ground. It's trading at 103 or thereabouts. And that traditionally has been positive for flows to emerging markets.
Yeah, so I think there's a few things going on there. But if we look specifically at bond yields, normally long-term bonds will have a higher yield than short-term bonds, and certainly a cash. We've got an inverted yield curve, which is very unusual. Typically it's what you see ahead of a recession. But I would highlight that the inversion today is extremely high. It's much higher than any inversion that we've seen, with the exception of when Paul Volcker was in the Fed and he had Fed funds rates at 20%. So this to me is an ongoing misprice. And I think we're mispriced because we're still anchored on bond yields that we experienced post the GFC, post the Euro crisis, when you had significant quantitative easing by central banks. You had a fairly large percentage, something like 40% of G7 bonds with a negative yield, as particularly the ECB, but also the BOJ were expanding their balance sheets. We're now back to a more normal world. We have a tight US labor market, we have inflation, we have good nominal growth in the US. We have central banks trying to shrink their balance sheets. They're very early in that process. And we have a deteriorating fiscal position. So I would argue that bond yields can go above 5%. If you look at a normal yield curve, so the difference between 10-year and 3-month money, it's typically around 1.5 to 1.75%. So, in theory, bond yields could go, if we stick with 5.5% Fed funds rate, bond yields could be above 6. I don't think they get there because there's such an expectation around a slowdown in growth. But maybe the story of 2024 is that the US economy doesn't slow down, which essentially has been pretty much the story of 2023. What's wrong with an economy that's generating this amount of jobs? You are getting a moderation in inflation, but remember, CPI-X is still 4%. The Fed's target is 2%. So I go back to, why would the Fed cut rates, and why is the market so enthusiastic about this call that the Fed is going to start to ease soon?
That's a fair point. So in that context, and the very last question is emerging markets, equities, and India. We've seen a bit of a turnaround over the last few sessions of foreign institutions coming back in, but there could be a bit of a hiccup to that based on what you're saying. Is India too expensively priced, or is that the price, do you think, that foreign institutions would have to pay to get into a market that's seeing relatively stronger growth?
Yeah, I think India is getting a pricing premium because it's a very rare story. So you have a robust economic growth. So we'll probably see 6 to 6.5% GDP growth in the next fiscal year. Inflation is high, but again, it's moderating. The current account is in deficit, but a modest deficit relative to India's history. And when you look at that compared to what you were noting about China, where there are real concerns now about deflation, India is sitting there as a major emerging economy with a good, robust macroeconomic story and plenty of good high ROE businesses. And so I think it will maintain the premium because it's a scarcity story. You have to pay up for these types of stories.